$847 million. That is your net investable portfolio. Not your house, not your business interests, not the art. Just the liquid and semi-liquid capital sitting across 7 structures in 4 jurisdictions. You have a CIO. You have a tax attorney on retainer in Luxembourg. You have a fund manager in Singapore who has never met you in person and never will. You are 67 years old. 31 years ago, you had $2,200 in a savings account at a regional bank you no longer remember the name of. The bank remembers you. It lent your $2,200 out at 6.8%. It paid you 0.4%. You didn't know that then. You know everything now. Level 1, the saver. You are 26 years old. You have $2,200 in a checking account and $800 in savings. The savings account pays you 0.4% annually. You think this is how money works. You deposit it. The bank holds it. It earns a small return. You withdraw it when you need it. This is not how money works. The bank takes your $2,200 and lends it to a homebuyer at 7.1%. The spread between what they earn and what they pay you is how the bank funds its buildings, its bonuses, its advertising budget, and its profit margin. You are not a customer in any meaningful sense. You are inventory. You don't know this yet. You're focused on the $800. It feels like progress. You moved it from checking to savings because a coworker told you to, and you read something online about emergency funds. You have 3 months of expenses saved. The articles said 3 to 6. You're working on it. The rule at this level is not stated anywhere. It operates silently. The system extracts value from people who don't know the system exists. You are in the system. You just don't have a name for what's happening to you. You make one decision at this level that matters more than any other. You automate a $200 transfer every month from checking to savings. You don't think of this as investing. It isn't technically, but the habit of moving money before you can spend, it is the only behavior that survives every level above this one. Everything else changes. That doesn't. Level 2, the index investor. You are 29. You have $14,000 saved and a nagging sense that the savings account is underperforming something, though you're not sure what. A friend mentions VTI at dinner. You spend a weekend reading. You open a Vanguard account on a Sunday afternoon. You set up an automatic investment of $500 per month. This is the correct decision. Not because it feels sophisticated, it doesn't, but because 92% of actively managed funds underperform their benchmark index over a 15-year period. You have just made the statistically optimal choice, without fully understanding why it's optimal. That's fine. Most people who beat the market don't understand why either, until they don't anymore. VTI gives you exposure to 3,800 US companies in a single ticker. The expense ratio is 0.03%. The fund you looked at briefly before choosing. VTI charged 1.1%. That 1.07% difference, compounded over 25 years on a growing portfolio, is not a rounding error. It is a car. It is a year of retirement. You feel responsible. You are. You check the account on the 1st of every month, briefly, then close the browser. You don't panic when the market drops 14% in October. You are mildly unsettled. You keep the automatic transfer running. This is the entire strategy. The strategy works because you don't interfere with it. At this level, the currency is time in the market, not timing it. You have 30 years of compounding ahead of you. You don't feel 30 years. You feel $14,000. The gap between those two things is the thing you can't see yet. Level 3, the stock picker. You are 32. You have $41,000 in your Vanguard account and a growing suspicion that you could do better. You start reading 10K filings. You find a SaaS company with 40% year-over-year revenue growth and a net revenue retention rate of 118%. You feel something you will later recognize as the early stage of overconfidence. You buy 80 shares at $34.20. The stock goes to $51 over the next 4 months. You feel like you have an edge. You don't. What you have is a bull market and confirmation. bias, and 60 hours of reading that gave you enough vocabulary to feel informed without enough sample size to know if you're good or lucky. These two things are indistinguishable at 30 to shares of profit. Over the next 26 months, you will outperform the index in 1 quarter, underperform in 5, break even in 2, and lose 31% on a retail turnaround play that a respected analyst on a financial podcast told you was undervalued. You will calculate your total return across the stock picking portfolio and find it is 2.3% below what VTI returned over the same period. You will spend a weekend not looking at the account. The tuition is approximately $6,400 in underperformance. You will call it a learning experience. You are correct. What you learn is specific and valuable. You don't have an information edge, a processing edge, or a behavioral edge over the institutional desks that move this market. You know more about investing at 34 than you did at 32. You know enough to stop. You move the individual stock positions back into index funds. The VTI account is now $67,000. The market did most of that. You did some of it. You're not sure which part is which. Neither is anyone else. Level 4, the portfolio builder. You are 37. You have $130,000 across 3 accounts. Your brokerage, a Roth IRA maxed annually since you were 30, and a 401k with employer match. You've stopped thinking about tickers. You think about allocations. You read about modern portfolio theory. You build a target allocation, 65% US equities, 15% international developed markets, 10% bonds, 10% rights. You rebalance once a year in January, selling what has run and buying what has lagged. This feels counterintuitive. That's how you know it's probably correct. The international exposure underperforms for 3 years running. You keep it. You add I bonds during the 9.6% inflation window in 2022 and max the $10,000 annual purchase. You buy Vuxis when it's down and feel nothing, which is the correct feeling. What you're doing now is not picking, it's engineering. You've replaced the question, what should I buy, with the question, what should my portfolio look like in 10 years, and what does it need to look like today to get there? These are not the same question. Almost no one switches from the first to the second before losing money on the first. Your net worth crosses $200,000 on a Tuesday. You notice it the following Saturday when you check the accounts. You don't celebrate. You rebalance 3% back into bonds per your annual plan. The number is significant. Your reaction to it is more significant. The currency at this level is discipline, not intelligence, not research, not edge. The ability to maintain an allocation through a 37% drawdown in 2022, to rebalance mechanically rather than emotionally, to not confuse activity with progress. You are building a system that runs mostly without you. That is the point. Level 5, the alternatives investor. You are 44. You have $620,000 in liquid and semi-liquid assets. A financial advisor at a firm you've been introduced to through a colleague asks if you've considered diversifying beyond public markets. You haven't. He explains what private credit is. You listen more carefully than you expected to. You invest $75,000 into a real estate debt fund targeting 9.5% annual distributions. The minimum was $50,000. 6 months ago, this product didn't exist for you, not because you didn't know about it, but because you didn't meet the qualification threshold. The fund is available only to accredited investors, $1 million net worth, excluding primary residence, or $200,000 annual income for 2 consecutive years. You qualify now. You've qualified for 8 months. You didn't know this tier existed. You add a $40,000 position in a structured note with principal protection tied to the S&P 500 with the 22% upside cap over 3 years. You invest $60,000 in a real estate syndication 200-unit multifamily property in Phoenix that your advisor's firm co-sponsored. The projected IRR is 14.2% over a 5-year hold. The projected IRR is always higher than the realized IRR. You understand this. You invest anyway, at a reduced expectation. Your public market portfolio continues running. Your alternatives allocation now represents 28% of total investable assets. The distributions from the debt fund hit your account quarterly. It is the first time in your investing life that money arrives without you doing anything. It is not a large amount. The feeling is disproportionate to the amount. Your liquidity has changed. $175,000 of your portfolio is now locked up for 3 to 5 years with redemption gates and limited secondary market access. You know this. You planned for it. You have enough liquid buffer outside these positions that it doesn't matter. But you feel the illiquidity in a new way. You understand now that liquidity is not free. You were paying for it at every prior level without knowing it. Level 6, the accredited investor. You are 49. You have $3.4 million in investable assets. The calls are different now. An operator you met at a conference 3 years ago sends you a deck. His fund is raising a $12 million round for a Series A logistics company. The minimum check is $100,000. The round is not on AngelList. It is not on any platform. It exists in a group text between 11 people. You are one of them because someone vouched for you and because you had a 40-minute conversation at a dinner in Austin that you almost didn't attend. You wire $150. You will not know for 6 years whether this was correct. You do 2 more angel co-investments in the following 18 months, $75,000 into a vertical SaaS business targeting dental practices, $50,000 into a climate tech company with a pilot contract from a major utility. One of these will return 3.1x. One will return 0. You won't know which is which for years. The private placements are different from the alternatives. Alternatives were products. These are relationships. Access doesn't come from wealth alone. It comes from proximity to deal flow, from being known in the right rooms, from being someone that other investors want at the table because your presence signals something. Your capital is now a credential. This is a different relationship to money than you have ever had. Your public portfolio is managed by Enria now. You review the quarterly report. You ask 3 questions. You approve the rebalance. You spend 40 minutes per quarter on $2.1 million in public market exposure. You spend more time thinking about the $275,000 in private positions. This ratio is approximately correct. The rule at this level is not about returns. It is about access. The financial system has always had a layer that operates on relationships, reputation, and invitation. You spent 23 years in the outer layer. You can see the inner layer now. You are not fully inside it, but the door is no longer invisible. Level 7, the family office. You are 57. You sold your business 8 months ago for $38 million net of taxes. Your investable asset base is now $41.7 million. Including prior accumulation. You hire a CIO. She comes from a $4 billion endowment and charges $380,000 per year in salary, plus carry-on outperformance. You also retain a tax attorney, an estate planning attorney, an insurance specialist, and a compliance officer. Your annual investment infrastructure cost is approximately $900,000 before any management fees paid to external managers. The portfolio she builds looks like this: 30% public equities across US, international developed, and emerging markets, 25% private equity through fund commitments to 3 established managers, 20% real assets, direct real estate, and infrastructure co-investments, 15% private credit, 10% hedge funds across 2 strategies, 7% cash and equivalents for liquidity and opportunistic deployment, 3% venture. These percentages are reviewed quarterly. They shift by 2-4 points in either direction, depending on market conditions and manager pipeline. The strategic asset allocation is set annually. Your CIO presents it. You ask questions. You approve it. You have moved from being an investor to being a governor of capital. Your tax structure is its own organism. You have a Delaware LLC as the primary holding entity, a charitable remainder trust managing $4.2 million in appreciated assets, a donor-advised fund with $800,000 earmarked for grants, and a grantor trust structure, your estate attorney set up to move assets to your children outside the taxable estate. The trust generated a 67-page document. You read 22 pages. Your attorney summarized the rest. You still check markets, less than you used to. The frequency of checking markets is inversely correlated with portfolio size among people who are doing it correctly. Level 8, the capital allocator. You are 67. The portfolio is $847 million. You did not accumulate $847 million. You stewarded it. The distinction matters and nobody outside this level understands it. You don't pick managers the way you once picked stocks. You evaluate them the way you once evaluated businesses: team, track record, strategy drift, alignment of incentives, fee structure, co-investment rights. You commit $30 million to a private equity buyout fund with a 10-year lock, 2 and 20 fee structure, and net IRR of 19.3% across prior vintages. You commit $15 million to a distressed credit manager you've known for 11 years. You pass on a hedge fund with excellent returns because the manager's AUM has grown 6x in 4 years, and you believe size will compress alpha. You are right. 3 years later, when the fund underperforms by 400 basis points and quietly closes, it's a share class. The market knows you exist in the way water knows a rock. You don't move markets directly, but $30 million into a buyout fund shapes which companies that fund acquires. Those acquisitions shape which regions get capital, which operators get funded, which employees get hired or restructured. You are 3 layers from the asset, and your decisions still alter the operational reality of people who have never heard your name. You do not attend investment committee meetings anymore. You receive the memos. You ask 2 questions. Your CIO runs the meetings. You hire the CIO. The power is in the hiring. The people you trust number fewer than 9. Your social world has contracted not out of loneliness, but out of a kind of natural filtration. Most conversations have become either useful or not useful. This happened slowly enough that you didn't notice it happening. You notice it now when you're at an event with people who knew you at 40, and the things they talk about feel very far away. You are not unhappy. That framing is too simple. You are something more like a line deeply embedded in a system that reflects your decisions back to you at scale, that responds to your positioning in ways that compound invisibly, that has made you something other than what you were. The system didn't do this to you. You moved toward the system. At some point, the distinction stopped mattering. You are in the market, but the market is also in you. You think in basis points when you hear interest rate news. You calculate IRR implicitly when someone pitches you an opportunity at a dinner. You cannot stop doing this. You are not sure you want to.